A crisis erupts at the White House. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, President Biden just authorized the unimaginable, and now experts are saying further chaos is expected. I'm going to show you the shocking truth behind President Biden's latest move and why it was entirely economically motivated as he hopes to seek a second term. Now let's head over to Bloomberg, where he picked today's story up with a headline as Biden says Trump left him, well, no choice as he moves to seal the border. And why all of a sudden is he doing this? Well, as you're about to see, it's everything to do with the economy that's changing rapidly, as we must face a simple truth: to protect America as a land that welcomes immigrants, we must secure our border and secure it now, he said on Tuesday. The goodwill of the American people is wearing thin. Nothing is going to be an option. We have to do this now, and it's not the goodwill of the American people. This is all about the political elite and how the economy now is rapidly changing. You're going to see why the real truth here shortly, as the new measures taking effect at midnight will shutter the U.S.-Mexico border to some asylum claims until the level of crossings there fall substantially and raise the threshold for people to stay in the country. Biden said the measures will stay in place until the number of people trying to enter the U.S. illegally was reduced to a level the country could manage. And what does he mean by manage? What does that have to do with anything about a number? Has everything to do about the economy and U.S. workers. Takes tune as we look now. Progressives have decried the moves as draconian, saying they will worsen as a humanitarian crisis without addressing the root causes of migration, while moderates and swing state lawmakers press the administration to slow the flow of migrants who are straining resources in communities across the country. So is this just about resources? Well, no, it's about the U.S. labor market. In fact, we see House Speaker Mike Johnson saying this is just window dressing. It's not going to reduce chaos at the border, and that is likely true. Weigh in your comments what you think this has to do. Will there still be chaos at the border? Is this the right move? Because as we look to the economy, you're going to find out it's all about the labor market. And one place you shouldn't be seeing chaos, that is your trading account or your 401k. When you see headlines like this, bonds yields are set to fall, and you're wondering, should I have rotated into bonds? Maybe in my 401k. You don't have to be a trader to make money in the market. Sometimes it's all about your biggest asset and being diversified. We showed our subscribers to be buying right down here. Can you imagine near the low? Here we're looking at the long bond TLT, and look at this return. This is not including dividends. We see our CTA Time Pro. We look at the machine positioning, and we aim to beat the machines, and we do it frequently. Or we have a tactical report called Momentum Time Pro. Look at those returns. That is as of a month ago. Could you imagine if you would have made that position change in your 401k, kept your diversification, added bonds, maybe in your brokerage account, your trading account, picked up some bonds here? How do we do it again? We take a look at the machine positioning every day across the market, stocks, bonds, commodities, currencies, and we look for when price moves against them and they have to short cover. We give you the report. We give you the trades in a video. Maybe you like to trade the technicals. We do that too. Except we run a proprietary overlay to get you in those trades, keep you in them longer instead of trading in and out and all over the place. That's called Momentum Time Pro. You get the report, you get the videos, you get our advice, and you get to start making money on many things. It's just that easy. Here's the best part: 30-day free trial. And if you jump on the free trial, you've got to lock this in, because my people tell me the subscription costs are going up. Lock it in now. And here we can see why Biden made this move. It has everything to do with payrolls, as U.S. hiring slows to the weakest pace and start of the year, and ADP data. And if you think about why migrants are crossing the borders, well, they're going to be looking for work. And this is a problem because the U.S. economy now does not need more people on the unemployment line looking for work. What they need is jobs, and we're not creating it. That's a problem as we head into the November elections. Remember, this is the critical time where people make their decisions about who they're going to vote for, and they make it based on the economy as job gains and pay growth are slowing going into the second half of the year. The labor market is solid. Well, is it? But we're monitoring notable pockets of weakness tied to both producers and consumers. Are you seeing weakness where you're at your employer and your city, maybe in your state? Weigh in the comments. Would love to know, because manufacturing firms that we've been talking about how they've been cutting hours. Now, according to ADP, they cut 20,000 jobs, the most since July. Professional and business services companies also shed workers by the most in more than a year. And that was something we were told was not going to happen. Remember, the economy was supposed to boom in the second half. Well, here we are, and we're finding out that companies are shedding jobs. And even on the services side, which everyone said would lead the manufacturing sector out of the slump, we said not going to happen. Employment in mining and information decreased, while hiring in the leisure and hospitality sector was the slowest since November. And that's not exactly what you want going into the summer season. You expect that leisure and hospitality should be adding people like crazy. Well, what that's telling us is bookings are down, travel is down. Of course, we know that means the economy is slowing, as ADP's report also adds the signs that the labor market is gradually cooling, as job openings fell to the lowest level in over 3 years in April based on government data this week. And while hiring has slowed, layoffs remain historically low, which is what Federal Reserve officials are looking for to help tame inflation without triggering a rise in unemployment. That is, if the data is correct, because what we're noting here is the slowdown is going to affect unemployment claims in a big way. Maybe part of the reason why, of course, we want to keep people from coming across the border to file claims. Here we look at total compensation in the form of average hourly earnings multiplied by average weekly hours of production and non-supervisor employees against continued unemployment claims. And when you see a deceleration in total compensation on almost each and every instance, it is matched with rising continued unemployment claims. So you start to make the case here of why we want to see, of course, these borders get shut down, keep people from coming across, because if they start getting on the system, it's going to add not only more people to the available pool of labor that's going to drive down pricing, it's going to show up on the statistics. Nobody wants to see that. And this is the big risk now, is this continued deceleration in total compensation is going to lead to a big increase in continued claims. And if you think about the timeline, now with 5 months to the election, it makes sense that we are likely going to be in an all-out recession by then. And wage growth slowed for workers who changed jobs for the second month to 7.8% from a year ago. Again, validating the demand is weakening in the economy. And earnings gains for workers who stayed in their jobs held at 5%, the slowest since 2021. So you start to think of why we're seeing weakening demand heading into the summer. Well, it makes perfect sense. We're seeing employees are noting their pay increases are decreasing, but costs in terms of consumer prices are not slowing down enough. This is critical. They just don't have the money to spend in the real economy. And when we look at average hourly earnings, something the political elites have touted are above inflation, well, we can see that decelerating. We're going to get the official number here on Friday, and we can look at that dotted green line, and that's about the average of average hourly earnings, and is headed right back to that pre-pandemic level. Meanwhile, inflation remains well above its pre-pandemic level, something the Fed would like to see come down. And we have noted that the Biden administration wanted to see lower interest rates. They wanted to see inflation come down, but they didn't want to see it as a sacrifice of the labor market. And that's the problem the president is facing right now. He's seeing early signs that the labor market is going to be gone by the time he asks voters to put him in for a second term. As bond traders pile into fresh bets on faster pace of Fed cuts, keep in mind last month we showed you to our subscribers, you should be getting back into bonds, as the new move that the Fed is going to make is ultimately going to be one that protects the strength of the labor market rather than one in which they need to be fighting inflation. We do think inflation is generally under control, and it would make sense because as consumers have less money to spend because their wage growth is slowing, their hours worked are getting cut, and some are even hitting the unemployment line, yes, demand goes away. And here you can see just how far the Fed is behind the curve. Again, we look at total compensation now against the federal funds effective rate. That's shown in red. And what do you note? That slowdowns or decelerations in total compensation are normally, not every time, but normally matched by a reduction in the federal funds rate. This time the Fed says, no way, that's way too high. Well, we're expecting this number to quickly drop down to pre-pandemic levels and then continue to fall as the economy slows and more people face losing their job. And this is the issue here. It's when the labor market goes, everything's gone. The problem is no one up top seems to believe it. And over Monday and Tuesday session this week, traders have been targeting protection against the faster pace of rate cuts, perhaps two by the September meeting. And if you were a subscriber and took our advice, this would be money in your pocket. Again, links in the description below. Grab that 30-day trial before we have to raise prices. As the Bank of Canada now cuts rates to 4.75%, signaling more to come. And again, this would be the news that the Biden administration would want to hear from the Federal Reserve. But we have suggested that if the Fed starts cutting rates, it means something's wrong with the economy. But I want to show you how the Bank of Canada is positioning this, because at some point the Fed's going to follow. They're going to use the same language. And here we can see they cut the overnight rate to 4.75%. Officials say they're more confident that inflation is headed to 2%, and it's reasonable now to expect further cuts. And with further, more sustained evidence, underlying inflation is easing. Monetary policy no longer needs to be as restrictive. And that's the key word we're going to hear out of the Fed, that they put policy at a restricted level, and now they're just going to back off a little bit. And this was all a part of their plan. Well, it wasn't. They have no idea exactly where the federal funds rate should be. They don't even realize it doesn't do anything. But nevertheless, it is what they believe. And you're going to see them pull back on this and say, we're going to bring it out of restrictive territory. Everyone's going to champion it until the economy continues to fall down. And overall, policymakers see the economy in excess supply. That is the issue we have been making post-pandemic. We've seen supply increase, demand fall, and wage pressures moderating gradually. Still, consumption remained resilient early this year, and the economy showed strong momentum headed into April, when the labor market added the most jobs in a year. Of course, that is if you believe the non-farm payroll reports, which we don't, because the underlying evidence here, we look at the ADP report, we look at total compensation growth slowing, we look at retail sales declining. If the labor market was as strong and robust as everyone wants us to believe, we wouldn't hear from the likes of Walmart, McDonald's, Burger King, Target. And what do we continue to hear from some of these major retailers is consumers are tapped out. They cannot afford low-end items even. They're cutting their discretionary spending. They're looking for deals. They're stopping going to the store all the time to focus on only the items they need. These are not indications of a strong labor market or an economy, which is why we're seeing now the services sector start to go. And if speaking of that, we have the U.S. services providers chalk up the strongest growth in 9 months. But really, it's the underlying data here that really matters. The headline number, don't be fooled by it, because the ISM's Business Activity Index, which parallels the group's factory output gauge, short a whopping 10.3 points, suggesting the services economy is indeed booming. And the measure offers some reassurance for the economy after a recent spate of weaker data. But no, the realities underneath here, employment challenges remain, primarily attributed to difficulties in backfilling positions and controlling labor expenses, suggesting that people are asking too much money. And if that means we know employers cannot afford these higher wages, that's a problem. Because why is that? Retail sales is falling. If the employers don't have the income, they can't pay their employees. Employees want the money, they just can't do it. The majority of responses indicate that inflation and current interest rates are an impediment to improving business conditions. But look at this as we take a look at the actual data. Backlog of orders virtually unchanged from last month, but still slowing a little bit. And new order growth popped up. That is getting everyone excited. But of course, employment still in contraction now for 4 months, saying that employers are not buying into this at all. They know demand is coming down, and starts to make sense why President Biden suddenly decided he needs to enforce border crossings. He just doesn't need any more people entering the labor market, because it just can't handle it. And we're at risk of them taking not only critical jobs away from U.S. workers, but from the whole entire U.S. labor market, about to fall apart and send the U.S. economy into a recession at the worst possible time for him. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.